Welcome and thank you for viewing the recording of today's session today, the fifth of our Wealth Accelerator series. We're going to be talking through different ideas mid-year to make money moves around how to finish 2025 strong. My name is Todd Doleshal. I'm the founder of Elevated Retirement Solutions, affiliated with LPL Financial. Been in the business for 17 years, and of course, in that period of time, heard a lot of shoulda, woulda, couldas throughout my career, personally and professionally. So today we're going to be talking through 5 actionable steps that you can help optimize the rest of the year now that the summer's over and we're getting back into the season with fall kids, etc., getting back in school. So with that, let's crack the books open. So today, what you're going to be learning about is a few different things here. So we're going to do a quick economic update and market check-in. We're going to be talking through the 5 financial moves you can still make this year, how to align your money with your goals, and what to consider next. And again, as a reminder, this is all for the purpose of education, not specifically financial advice. And yes, I am a financial advisor. So if you have any specific questions or ideas that you want to bounce off of me, feel free to shoot me an email or schedule some time on my calendar. So let's go ahead and dig in. Okay, so talking through where we're at right now economically here. So inflation, relatively speaking, has been cooling, but prices are still sticky, which means that unfortunately we just have not seen the downward trajectory that really the Fed is looking for in order to feel comfortable lowering interest rates, which would help stimulate the economy. The other end of this, unfortunately, is the jobs market hasn't exactly been very strong lately just for a lot of reasons, whether it's, the disruptions and enhancements with artificial intelligence, wage increases that have made it harder and harder for organizations to absorb that. You throw in tariffs for those who are impacted, and it's all creates a very difficult period of transition where there's just a lot that's up in the air right now. So the Fed's policy up to this point has been because we haven't lowered and seen core inflation under 2% to remain steady so that we don't create a hyperinflation environment similar to what we saw back in the 80s and certainly in the 70s. Uh, it'll certainly be interesting to see what happens going forward. But if the weak jobs reports continue, that does tip it more and more likely where the Fed will start considering cutting interest rates because of the situation that that's in. So that's the balance is keeping inflation under control, but also not doing it too much to where it impacts the job market, all things being equal. From the market, in terms of investing, certainly has been a very interesting ride. Technology has been very strong of late here now that we've rebounded from the dips and the lows in March and certainly in April. But we are starting to see a lot of profit taking where technology the last few weeks has gone down. Communications, energy, et cetera, has also done very well here for the year. Again, not making any specific recommendations on this, but a good opportunity to certainly look at your reports and your investments and making sure that you're not overweight in any one sector here. Last but not least, housing has really been a very, very, very tough market for home buyers and certainly for home sellers for several reasons. Prices, while they aren't increasing as fast as they were because of inflation coming down, that doesn't change the fact that prices have just skyrocketed in real estate, making it very hard for people to purchase homes. And the housing affordability index that the government tracks continues to go down annually, unfortunately. Couple that with very, very high interest rates on mortgages. So you're talking potentially 6 to 8% based upon a number of factors, and that's assuming it's a primary residence, which is at a discount rate compared to investment properties. And all that makes it more and more expensive for people to buy homes here. So banks and credit unions are really tightening how much they're willing to lend, which is good and bad, right? It's bad for those who are looking to loan, and that unfortunately that makes it tougher and tougher for them to qualify. And if they do, they're having to pay higher interest rates. But then the other end of that is that they're not just giving away loans the way that they used to pre-2008. So that's both a good and a bad thing from that perspective. Okay, and why mid-year planning is a must. Really, the big thing here is trying to avoid surprises at the end of the year. It's very common and typical for people to procrastinate when it comes to money or other things that they really enjoy, or conversely, don't really like to think all that much about. One great idea for now would be to take this time to look at interviewing CPAs, and accountants, and figuring out your plan for 2025 tax planning. Because if you wait until Q1 of next year to start interviewing CPAs, I can tell you it's too late, right? And if they are taking on clients, that also could pose a problem from a bandwidth perspective as well as quality control. So taking a look at this is important to make sure you're withholding the right amount and that you're doing the things we can be doing for you. So we're going to talk more specifically about this. Okay, so money move number one. Really, the most important thing here is what are we doing, right? What are your goals? What's changed in your life and your priorities? Because let's face it, life and the world around us has certainly not been static or unchanging this year. It's been very up in the air in terms of the market, politics. Things have changed a lot. But what going back to your tree instead of the forest view level. What are your priorities at this point in time? Just to check in, revisit those goals that you might have put in place for New Year's resolutions in January, whether it's to get your budget under control, save more, spend less, and donate to charity, so on and so forth. And then adjust your spending and savings and risk tolerance accordingly. Money move number two. This is a biggie. Rebalancing your portfolio. With the stock and the bond markets, real estate, and alternative asset classes, really just having just a phenomenal year in some respects and really tough in other sectors. This could be a great opportunity for you to rebalance your portfolio. For those of you who I work with, those are done automatically as a part of the discretionary accounts I manage. But in terms of your retirement accounts and otherwise, this could be a great opportunity to also rebalance your 401k, your 403b, your 457, and so on and so forth. Because by rebalancing, what that does is it forces you to sell the asset classes that have gained the most, therefore locking in profits and selling at a high. And then conversely, buying other asset classes that haven't performed as well, such as small cap stocks, etc., at a discount, right? Because as we know, in the long run, and the investing market is a pendulum where it tends to swing back and forth between really overvalued, really undervalued, and this is a great way to bring us back into alignment with your original risk tolerance. And then, of course, consider reallocating your cash. If you've done a really good job saving along the way this year and you have a good stockpile of cash, consider throwing that into some different accounts that are going to save you quite a bit of money in taxes and gain you high interest rates. Whether that's Roth IRAs if you're eligible, backdoor RAs, traditional IRAs, CDs, non-qualified annuities, and so on and so forth, all of which could be good tools from that perspective to reallocate your cash and make your money work harder for you. Because if that money continues to accrue and sit in an account that's taxable, if it's paying 4% if you're lucky, you don't actually get the 4% because you have to pay both federal income taxes on that and state income taxes if you live in a state that has income taxes. Money move number three. So this is where updating your tax strategy is extremely critical. So four key ideas here to talk about. One would be Roth conversions. Roth conversions is where you take money from a traditional IRA, convert it over to a Roth IRA, thereby paying the taxes on it, and then investing that into a Roth IRA so that the money can grow tax-free. So this is an excellent way to manage your tax bracket for the future, because if you're very top heavy and focused almost exclusively on 401ks and traditional IRAs, as oftentimes I see a lot of people are before I start talking with them and working with them for that immediate tax break. The problem is when you pull that money out, not only is that what you contributed going to be taxable to you at ordinary income tax levels, also so will the growth. So from that perspective, great opportunity to manage your tax bracket from that perspective and control it so that when you do need to pull money out for one reason or another, you've got access to those funds after 5 years, unlike a traditional IRA or 401k where you'd have to pay 10% penalties as well as ordinary income taxes. Tax loss harvesting would be another one. So tax loss harvesting is essentially where in a non-qualified account, you can invest in stocks, bonds, and all kinds of asset classes. And if you've held that investment for more than 12 months and there happens to be a loss, that could be a great opportunity to intentionally sell that as a loss, and then that will offset future gains. And if you don't have enough gains to offset that, then you can write off up to $3,000 against your income tax return as what's called an above the line deduction, meaning that you can write that off regardless of whether you itemize or not, and any losses beyond 3,000 continue to carry forward into future tax years. So really great strategy from that perspective, and that's why it's good to have a lot of different investment accounts, as I've mentioned in past webinars, between tax deferred, tax free, and then taxable. Number three, adjust your withholdings and your estimated payments. If you have seen a nice change in your income, whether that's up or down, good to take a look at that. Just seeing, are you on track? And if you're not withholding enough, or conversely withholding too much on your taxes, it's time to update your W-4, which is the report that goes to the government to adjust your withholding. Last but not least, smart charitable giving. If you have required minimum distributions, whether that's on inherited investment accounts, or have it in your own name if you're over 73 or beyond, then you can take your deduction from that, by meaning that if you need to do a required minimum distribution of $5,000, rather than you paying the income taxes on that, what you can do is donate that to a charity from your investment account. And then not only do you not have to pay taxes on it, but then the charity gets that as a deduction. So really great opportunity for all kinds of things with charitable donations, as well as donor advised funds, which is a great opportunity to gift highly appreciated assets that you otherwise would pay taxes on, and give that to the charity, which they get to sell and invest on a tax-free basis if they're a certified nonprofit, and you can direct those funds. So lots of different ideas as relates to this from an estate planning standpoint. So again, just reach out to me if you have any questions on any of this. Money move number four, check your retirement contributions. If you're working, and of course, there's a lot of different tools out there. Are you on pace to max out your 401k, Roth 401k, Roth IRA, or traditional IRA? All those have specific limits based upon your income. And of course, if you're 50 or older, there's different phase out catch-ups that are unique to this year. So take a look and see, are you really maxing that out? And one possibility could be maxing out a Roth 401k and a Roth IRA in the same year, even as a high income earner, including doing backdoor Roth conversions if you're over the contribution limits. So lots of potential here to really build up more and more tax-free wealth for you, so that you can pass that on to your future beneficiaries, use for yourself, give to charities, so on and so forth. For business owners, because I work with a lot of those, there's a lot of potential for solo 401ks, SEP IRAs, etc., all of which give you very generous benefits that could allow you to defer and make a deduction of at least 70,000 based upon your income in any one year. So much more benefits from a business owner perspective, because you get both the employee ability to max out as well as the employer, and then a profit sharing on top of that. So and then we're not even getting into cash balance, deferred pension plans, and others beyond that. So very exciting from that perspective. But again, just with this, check your retirement contributions. Make sure that you're doing your best to try to up that and increase that to the point where you're maxing each of those accounts out. Money move number five, protect what you're building and review your insurance and estate plans. So life happens, as we know, and certainly family dynamics and otherwise goals change. So when's the last time you reviewed and update your beneficiaries? Do you need, if you've done a great job putting together a trust and done all the estate planning, it doesn't matter unless you actually go follow through and update the beneficiaries and or the ownership to that trust in that example. Also, taking a look at the funding of it, making sure that if something happens to you, you have proper life insurance, long-term disability insurance, long-term care insurance, if applicable, right? Maybe it's better to self-fund some of those things. It's really a matter of just running the math, and from a variability standpoint, seeing what makes the most sense. But especially for people who are younger, might have younger families, that's typically where they may not have accumulate as much assets as those who are closer to retirement that have the ability to self-fund some of those different risks from that perspective. So again, all of this is about protecting your wealth, both for you and your family. So, quick recap of the top five money moves for mid-year. One would be to revisit your goals, make sure you're in alignment with where you're going, have real clarity around this, and really sink into how that's going to feel for you to continue to accomplish those goals. Consider rebalancing your investment strategies to lock in gains and conversely buy in a dip. Update your tax strategy while we still have time to interview CPAs and plan accordingly for 2025. Max out retirement contributions and arguably most importantly, protect your plan. So when something goes wrong, not if, then we've got to get a documentation for all this from an estate plan. And if you're already a client, of course, these are all the topics that I'm going to be discussing with you. So feel free to book a scheduling session and link on my calendar if we don't have a schedule already scheduled. And then obviously feel free to shoot me any questions or of any updates. And if you're not a client, feel free to just reach out, no pressure. We'll have a clarity session where we're just going to talk through your goals, figure out where we should go from that perspective, and we'll discuss the different opportunities to engage in working with me and other resources that might be appropriate for you. And my email address and my phone number are right here. So again, quick disclosures, the side effects, so to speak, that you might see in pharmaceutical commercials, right? Otherwise, again, all these investment strategies, tax planning, everything we've talked about here, all these comes with risks, right? And nothing is guaranteed as relates to investing, right? That's why it's important to look at the pros and cons of any investment strategy or goals that you might be looking at so that you can personalize this to you. So with that, I just want to say thank you so much for attending today's session. If you have any questions on anything of other topics you want me to cover, whether it's after this session or next month, please don't hesitate to let me know. And thank you so much for listening to today's session. If you've got any questions, feel free to send me an email at the link provided. Got my website there, as well as my phone number as well. So thank you, everybody, and I hope you have a wonderful rest of your week and enjoy the start of your fall.